So first of all, let's take a look at what happened on cotton prices in the past several years. So this is the price happened since January 2016. What we experienced. After that is a period of time of tariff number 1 in 2018, and then followed by COVID that shut down the entire world, and cotton prices plummeted during those time. And then shortly after that, there's a stimulus bill passed all over the world that boosted our economy and boosted the cotton prices as well. As well as after that, there's also a phase 1 trade deal signed at the end of 2019 that increased the purchase from China of U.S. cotton in 2020 and 2021. That increased the cotton prices skyrocket to be over $1 period of time. This doesn't work. And then after that, we have inflation pressure, and the Fed are trying to work really hard in fighting inflation by raising interest rate. And all those factors impact the cotton prices, and what we are experiencing right now is what we're seeing over here. And there's a spike before that. It's during another restocking by China, trying to get a lot of cotton before the election result coming up, because there are some anticipation about after election there are going to be a lot of trade talk and tariff going to play in a role. So there's a period of time of restocking. What we are having right now is just very stagnant prices ranging around the middle, lower 60 cents per pound. This is a chart produced by IMF trying to focus the economy globally, both emerging economy, advanced economy, and the world as a total. So what the IMF focusing is like return back to normal economic growth. As we see, cotton is a discretionary item. The purchase of cotton follows the economy. When economy going well, cotton purchase going high. When economy going down, cotton purchase going low. But IMF does focus the economy to be like a normal type of trend. It's not going very high as what we experienced right after COVID. It's not an economic downturn too. So you would expect on normal circumstances and normal situation, cotton prices shouldn't be at this low because the economy is doing very well and doing okay. So the cotton prices should be around the range of middle 70, upper 70, or lower 80 cents per pound. But why are we experiencing these lower prices, middle 60 to lower 60 cents per pound? And today I want to try to work with you, trying to provide some explanation or perspective on that. And here is the world cotton demand and supply. The demand and supply, it matches each other. And also what you see as the green line, I apologize for whoever colorblind cannot see this one. The green line on top, this shows the world demand for cotton. It didn't drop significantly or didn't rise significantly. It's at a normal demand situation. But when we take a look at the supply matches demand. There's not big fluctuation in supply as well. But if you look at closer into the supply, this is China, this is India, this is Brazil, and this is us. China and India, they are major producers of cotton, but they doesn't export cotton that much. The two countries export a lot. U.S. used to be the largest country exporting cotton, and now Brazil catching up and take over. So this is really related to global competition between U.S. and Brazil. So here is the top 3 cotton exporting country: U.S., Brazil, Australia. What we see in the past several years, since I started working at UGA, Brazil export rises tremendously. And last year, Brazil overtook United States and became the largest cotton exporting country. Why is that happening? Because Brazilian production, from my study with agri-benchmark trying to compare different production costs all over the world, Brazil cotton production is significantly lower than what we produce over here. Currently, they are still able to make a profit at 60 or just break even at 60, around lower 60, middle 60 cents per pound. But we cannot break even. We cannot even cover some of the variable costs over here because Brazil productivity or yield is 1.8 times higher than the yield we are gaining over here. And then another reason is historically Brazil cannot compete with US cotton, mainly because of infrastructure, lack of road, lack of transportation, lack of port. But since the last decade, there is significant Chinese investment in the Brazilian infrastructure industry that significantly boosted the efficiency of transportation of cotton or agricultural product from the farm to the port and be able to ship it overseas. So that's another part increasing the Brazilian efficiency. Plus that, the tariff also play a role. The trade tension worldwide also play a role in terms of the trade relationship or relationship of buyers with the sellers of cotton market. So this is a graph that produced by Dr. Hudson from Texas Tech University, comparing about the production, total production from the U.S., total export from the U.S., which is the blue line production, darker blue line, lighter blue line export, and then the Brazil production, darker green line, and Brazil export, lighter green line since 1980s. And you can see the significant fast pace of rising cotton production around 2016 or 2018. That is mainly after the first phase of trade tension between U.S. and China happened in 2018, and after that, Brazil agricultural production significantly increased, that including cotton too. And then let's take a look at the mainly U.S. customer in terms of who buys our cotton. China used to be the largest one, number one, followed by Pakistan, Vietnam, Turkey, Mexico, Bangladesh, India. And this is what happened for the last 5 years. And remember the prices in 2022, we see a very favorable prices because China bought large amount of US cotton during that year. So cotton is very vulnerable to agricultural trade policies overseas. And what is happening right now because of all the trade tension between US and China, this is compare what is the available data produced by USDA in terms of cotton export in the year 2024 compared to last year's data. So since the trade tension started April of last year, our total amount of export of cotton didn't change compared to the same period of time. 0% change export to the entire world. But China declined import from US cotton by 87%. And those declining in purchase from the US are compensated mainly by Vietnam, Turkey, India, and Pakistan increased a little bit too. So what we are experiencing is instead of shipping a whole bunch of cotton together to China, we are using that amount, we are reshaping that amount to the other countries that purchase a smaller amount. So that's increased transportation costs for US cotton when we're reaching our customers. So that is another reason why we are experiencing lower prices than before. And this is the slides I borrowed from Dr. Robinson, and he allowed me to do that, to borrow his slide. Maybe he can talk a little bit better than I talk over here. So the concept is there are two types of fund managers buying the futures of cotton. One is hedge fund, another one is index traders. Index traders are more stable. of traders, hedge fund traders, and the speculators. So we see whenever the speculators pull the money into the cotton market, that will shoot the market skyrocket very high. So if you see the green line, the green bar increase, then the cotton prices or the red line increase as well. What we are seeing since later or beginning of 2024 is short of futures in cotton market. And they have been shorted for so long. And that kind of doesn't make sense to me, because you are expecting if the price is gonna fall, you short it, and at a certain point, you cannot short all the time without closing all those futures contracts. You have to buy it back at a certain time. But they have been shorted for 2 years. So I'm wondering whether this is really a market driven or there's something going on. But at a certain time, they have to equalize or close the contract. So they have to buy those short back, or they have to buy this futures back. So there might be some opportunity when they are starting buying back, the price is gonna shoot up. And this is also another chart I borrowed from Dr. Robertson, saying who is the entire world import for cotton, for global cotton. So what we see, the light green area over here is China. Mainly the bottom is China. You see China bought a lot in 2023 and then reduced the purchase or import from global market. If we align these two charts together, or the prices spike, what experienced in around 2011, 2012, and the spike in around 2023, 2024 with the Chinese purchase, it aligned quite well with each other. So that shows the vulnerability in terms of cotton subject to the trade policy overseas, the agriculture policy overseas. As you can see, China reduced the purchase from global cotton in the year 2024, 2025, but those purchases are being compensated by the other countries. Another thing is there's some hope going on. I want to add some idea of hope going on for this year, because there are some talks about President Trump gonna visit China, trying to be set up in April. So if we are seeing some positive thing related to the trade negotiation, that could neutralize or turn around the wheel from the low cotton prices to be a little bit more favorable than what we are experiencing right now. But I want to be cautious on that. Trade talk is very volatile. You don't know what's going to happen until it's signed on contract, until it's signed with any trade deal. During the transition period time, there will be a lot of ups and downs, a lot of volatile. But sometimes volatility in the market means there are opportunities. So if you see the opportunity that can cover up your production costs to help you to go through this year of difficult time, don't try to wait too much longer. You can book a certain proportion, 5%, 10%, 20%. It depends on you see how the favorable of the price is gonna be. If you see it can cover my variable costs, cover a proportion of my fixed costs already, I book 5%. If it becomes more favorable, I book another 5 to 10%. Don't try to say, I wait until the prices shoot very high to do that. So what I think this year is economic risk analysis become very critical, important for survival. And then this is what I pulled from barchart.com this morning in terms of the cotton prices for this year, last year's crop, 2025 crop, and this year's crop for 2026. As you can see, currently 2025 crop traded around 62 to 67, and futures prices for this year's crop, it traded from 68 to 70. So there's some risk factor playing a role, because the longer the futures prices, of the time, the higher the price, because there's some risk associated factor add into the price. So what I see is there are a lot of global competition, especially from Brazil, that compete with U.S. cotton, and those competition is there, not gonna move around, not gonna go away in the near future, because they already established the market, their consumers, they already established the transportation, the infrastructures, so the competition is there. And the trade tension between U.S. and China probably gonna last for a while too. And what we are experiencing right now is U.S. cotton market need to find alternative market. We are in the transaction phase. So sometimes when there are challenges, it's also another way to force the industry to think outside of the box, not to be in our comfort zone as we used to be. So trying to seek alternative market, trying to seek what are other ways to improve the consumption of cotton. So that's the reason why the Buying American Cotton Act is one area that is trying to add a different perspective, a different way to seek for alternative market for cotton, or increasing the market for cotton, and then trying to seek other trading partners in addition to one partner we rely on heavily, trying to diversify the customer to reduce the risk. That is what the cotton industry could think for the future. And then what I expected for the prices is probably around 60, middle 60 to lower 70 cents per pound for this year's crop. But remember, there are some trade talks could be happening, so that adds some hope in terms of the prices outlook. So if their trade talk is favorable, we could be experiencing middle to upper 70 cents per pound for cotton for this year. So this is what USDA Economic Research Service produced in terms of the total cost of production, including total cost, revenue, and what is the profit or loss. So what we are experiencing since 2022, even though we have high prices, the input prices are also very high. Cotton has been suffering from loss for 3 years so far. 2025's data haven't been coming up yet. If we have those data, it probably gonna be even further down the road of loss. So that makes it very important in terms of the financial management for cotton, or financial management for your farm. Managing cash inflow and liquidity is very important. When you purchase large equipment, you really need to think twice of whether I really need that right now. But if you see some good deal and you think you are financially stable, this is also a market opportunity for you to jump in to buy equipment on sale. When I was in graduate school, I have a finance professor who always tell us that you save money during good times, not trying to purchase a large equipment, so that you can save the money for rainy days when everything is on sale, and then jump into those opportunities. During good time, not trying to spend the money to not paying taxes, pay the proportion of taxes or profit, those money saved from purchase equipment in the downtime when everything on discount, take the market opportunity. And then also because we still have very high loan rate, interest management is also very important. I want to say that this economic downturn, what we are experiencing probably gonna last a while. As University of Missouri, February projected another 5-year economic downturn for agriculture. And then we are ranking number 3 in terms of farm bankruptcy in Georgia after Arkansas and Iowa, and that is study found out by University of Arkansas. And then all this trade uncertainty produce some risk for agriculture. So that's the reason, because the price is low. From last year, we planted a lot lower cotton all over the U.S., 9.1 million acres. And this year, I do expect the acres, if there's no favorable prices change, the acres probably will be the similar situation or even lower. So that is what I want to update on the cotton outlook. Really quick about policy. So last year, one big, beautiful farm bill gave some update on Title C commodity programs, including reference price, change of ARC coverage level, and there are some opportunity for new base acres and loan rate, and also increased payment limit. So reference price starting from last year's crop, a 2025 crop, it changes from what is on the 2018, what is the black one to the red one. And for seed cotton, it increased 14% to become 42 cents per pound. So if you convert that to into length, it probably around upper 80 or lower to middle 80 cents per pound for cotton in terms of the coverage, cotton length in terms of the coverage. And then the reference price, there are also some factors that can be changed after the year 2023 according to some calculation to increase the reference price. And then ARC coverage level, it also changes from ARC guarantee of 86% to become increased to 90%, so that covers higher, as well as the payment limit. It used to be only 10% payment limit. You can only get 10% of the guarantee. Now it becomes 12% in terms of a benchmark revenue guarantee. And then there's a one-time allocation of new base acres. So this is a great opportunity. Make sure you talk to your FSA office. If your planted acre and your current base acre are different, your planted acre are higher than your current base acres, get the new base acres. That is the part that you can get new acres so that you are eligible for the farm programs. And here is the marketing loan rate is also increased for cotton too, from previous between 45 cents to 52 cents, now become 55 cents per pound. So what I think the loan rate works is it provides some intertemporal financial options for producers. The loan program, it offers lower interest rate than most of the operation loans. So you can use the loan program to sell cotton, to not sell cotton and store it. And then when the prices goes more favorable, you can sell it. But the loan program provide you the opportunity to be able to receive cash upfront so that you can pay back the operating loans. So especially starting from this year, there are a lot of producers struggling with the cash flow, so the loan program could offer some opportunities to help with the cash flow. And then the payment limitation from the One Beautiful Farm Bill increased from 125,000 to 155,000 per entity for all the covered commodity except for peanut. For peanut, have additional separate 155 per entity. And then it also, for the future year, this payment limit can increase according to some inflation index. For ARC and PLC and stacks, if it's the same with the previous farm bill, if you enroll in stacks, the farm commodity program are not eligible for your farm. The stacks will work if your farm don't have any cotton-based acres. You can enroll those into stacks. But if you enroll in stacks, then the farm operation won't be eligible for ARC and PLC. And based on the current commodity prices, stacks for crop insurance prices is not very favorable. ARC and PLC provide a lot better guarantee for your farm. So compare between ARC and PLC if you have cotton-based acres, and then forget about stacks. If you don't have cotton-based acres, you can consider about purchase stack insurance. And then the One Beautiful Farm Bill also have some equity entity change for the farm. Now, S Corporation Limited Liability Company can be eligible for FSA program, can be eligible for the Title I programs. A lot of producers operating as a sole proprietorship or partnership, that put a huge risk for agricultural production because the personal asset and business asset, there's no separation. By being able to become a LLC or S corporation, you are able to separate your personal asset from the business asset, protecting your own home, your own car from the business loss in terms of bankruptcy. So that is something I want to put into your mind to consider for the future operation of your farm. And then here are crop insurance options for cotton: deep loss program, shallow loss program, and then additional loss program. The traditional yield protection, revenue protection for covering crop insurance, and then the SCO, ECO stacks for covering additional shallow loss program. What you can do is to combine these programs, mix and match them together. This graph is a little bit complicated, but the idea is you can purchase the deep loss, yield protection, revenue protection, at the same time add on the additional stacks or ECO and SAO. This provides you some idea of how to combine those together. Or you can only purchase stack without any traditional yield protection or revenue protection program. And then the changes in the crop insurance, including higher subsidy rate from 65 to 80% for all ECO, MCO, hurricane insurance, and also fire insurance. And producers now have the choice to enroll in SCO regardless of whether they in ARC or not. Previously, if they enroll in ARC, their farm is not eligible for SCO. And SCO coverage level increased from 86% to 90%. And if you are interested more in crop insurance, colleagues from University of Arkansas produced a handbook, dive very deep from how you find insurance agent, how to work as agent, how to do claims, how to select different crop insurance. So this is the book I recommend you take a look at it. And the sales closing date for Georgia is February 28 for cotton crop insurance. So keep that in mind. And also the final planting date for Georgia is June 5 to be eligible for the crop insurance. And these are all I want to update with you. Any questions, comments?
All right, so some of my slides are repetitive, so I might, Dr. Liu did a really great job covering some of the macro stuff, so I might skip through some of those. Talking about global GDP, she already did that. This is one slide that I would like to show with you, and this is just looking at an index focusing on the crop sector of input prices and an index of producer prices received. So the blue line, let's see which one's the laser. Oh, the laser doesn't work. Okay, the blue line is the crop sector index for prices paid, and this is using 2011 as a base year. So that set 2011 prices as 100. So looking at the values there, this is basically how prices have changed since 2011. Okay, the orange line is looking at prices received. Now, it's not necessarily saying that the prices paid are more than prices received because there's production efficiency and things like that. But what it is showing is how input prices have changed and they haven't come down. Whereas commodity prices, so they went up. You know, shortly after the pandemic, when we recovered it, there was a lot of inflation that occurred. We had monetary policy where the federal government was putting a lot of money into the system. And so we saw inflation skyrocket for a lot of things. And so shortly after the pandemic, we saw prices increase for everything. And since then, they haven't come down in terms of inputs. They have come down in terms of commodities. And if we look back at this slide here, a lot of commodity prices are reflecting large supplies. So we have bountiful supplies. Dr. Liu talked about some issues in terms of exports have reduced for some of the commodities. And so that's one thing that's impacting demand and impacting price, certainly. But recently we've seen stagnant prices in terms of several of the commodities. But I think it was in October of last year that we saw the biggest gap in this index between the input prices paid and the output prices. So that's one of the reasons that there's different programs being put out like ECAP and the Farm Bridge Assistance Program, because Congress is hearing about that spread and the challenges that producers are facing in terms of low commodity prices, and input prices haven't followed that same pattern of coming down like the commodity prices have. All right, so this is some headlines from John Deere that were published towards the end of last year, and they're providing some outlook. And what I was wanting, the whole point of this was to provide like a little nugget of hope, because to me what I was reading is that, okay, they're seeing that 2026 might be the bottom of the large ag cycle. If FAPRI's predictions are right, we might see 5 more years of difficulty. So that could happen too. But maybe 2026 will be the bottom and we'll start slowly coming out of that. So hopefully this is taken as a nugget of hope that if we can survive 2026, maybe we can crawl out and get through the next several years. We've already talked a lot about trade, so I'll skip that one. Shipping costs are down, so that is certainly helping some of the transportation costs, which is really important for cotton because we export a lot of our cotton. It's showing that inflation is coming down, not just in the US, but also globally. So that is certainly helping for sure. Other things looking at the economic environment, usually that I talk about are interest rates. Those have come down a little bit. So we're looking at operating notes around probably a 7.5% on average next year for 2026, but ranging from 6.5% to 8.5% in terms of those, and other aid packages. This is dated. So this is looking at price changes of inputs 2025 compared to 2024. So it's not as current as I would like. But it's just showing how we saw increases in prices in livestock and poultry, labor, interest, rents in 2025. We saw lower prices in feed and fertilizers, seed, pesticides, and fuel in 2025. So what are lenders' concerns for 2026? So credit is obviously a really important input for producers. And what they're seeing is the same thing that y'all are worried about as well, is that working capital is eroding. And that's looking at liquidity, the ability to pay debt that is coming due this year. So seeing working capital eroding, certainly some relief, or I guess the Band-Aid to a wound, will help from the Farm Bridge Assistance Program and improvements from the One Big Beautiful Bill, those payments that will come in October. So that will certainly help from that working capital standpoint. But there's certainly concern out there about that and farm income levels being lower. All right, looking about land, a very, very important input for producers. And farm real estate values have maintained their values and continue to grow, but the rate of increase has slowed in terms of farm real estate values, but it's still an important asset in terms of collateral. The one good news that I'm seeing from that is that cash rent rate of increase has actually slowed as well. And for the first time since several years, we actually saw for the state of Georgia, the average value for irrigated cropland decreased $1. So I have these numbers up here. These are from the USDA National Ag Statistics Service. The values that you pay on your farm or your neighbors may pay might differ from this. So keep in mind that this is an average for the state, and there's a lot of variation from north to south, east to west, and even within counties. So I like to show these numbers just because they're a good value to put in, like the crop comparison tool and the enterprise budgets, to help us in calculating break-even prices and break-even yields. All right, from a fuel standpoint, we're looking at farm diesel prices staying relatively similar to what they were last year. I have $3 a gallon in the enterprise budgets, and that's what we had in the 2025 enterprise budgets. And a lot of that is a reflection of global demand. There wasn't much reaction to the situation in Venezuela from the oil markets because it will take a long time for things to happen in order for us to access the oil if the U.S. does end up accessing that oil. A lot of money, investment, people, and infrastructure would have to be put into place. Unfortunately for growers on the input side, we've seen fertilizer prices increase for nitrogen and phosphorus. You can see the bottom left numbers that we have there for NP and K, 2026 compared to 2025. So certainly a big jump in terms of nitrogen and phosphorus, but potash we've seen stay relatively flat. The fertilizer industry is getting a lot of news over the past day or two, saying like we're going to investigate if there's collusion or anything going along that, limiting supply and holding prices high. So we'll see what results of that. But for now, it's expected that fertilizer prices are going to be up in 2026 compared to 2025. As far as other things that I saw in looking at the input prices and updating the enterprise budgets, pesticide prices are up compared to 2025. Machinery and equipment prices are up just a little tiny bit. So they were kind of flat to just slight increases in machinery and equipment prices. We do expect for labor prices to be down in Georgia, primarily driven by that lower adverse effects wage rate. Instead of it being $16.08 or $16.80 an hour, it's going to be $14.47 per hour in 2026. All right, I'm going to talk a little bit about the Farm Bridge Assistance Program. Everyone has probably seen this. This was taken directly from the Farm Service Agency website. This is expected to come out by the end of February, and it's based on acres that were planted in 2025. We have had some questions about wheat, like what if I planted wheat in 2025? That one will not be eligible. If you planted wheat in 2024 or maybe January 2025, that would be eligible. It needed to be harvested in 2025 and not used as a cover crop. So it needed to be planted as far as a grain is concerned. Double crop planted crops are eligible for payments through the Farm Bridge Assistance Program as well. The Farm Bridge Assistance Program has a payment limit of $155,000 per person or entity, and that is separate from the payment limits in the One Big Beautiful Bill Act. So a grower who has base acres and could potentially get payments from the PLC program from One Big Beautiful Bill. They could potentially, if they had base for peanut, base for corn and cotton, they could see potentially 3 payment limits if they planted those crops. As far as eligible producers, growers are eligible if their adjusted gross income is under $900,000. I have not seen anywhere that there's an exemption for if 75% of that adjusted gross income comes from farming and agriculture. So the One Big Beautiful Bill has that limit as well, but there's an exemption for those that have an AGI above that as long as 75% of their production comes from agriculture. I just want to add to what Dr. Liu shared in terms of policy updates. So this is a chart that was put together out of FarmDoc from the University of Illinois with estimates of what payments may be. So if you recall, the One Big Beautiful Bill said that based on the 2025 crop, growers will get the higher of ARC or PLC. Now, these values are probably going to change because it was based on data, market year average prices, all of that as of November. And we've seen some of those changes, those market year average prices already change a little bit. But this is kind of an approximation of what payments may be. Now, this would be coming in October of 2026, so in the fall of this year. So growers will get higher of the 2025 ARC or PLC, and the estimate The dollars per base acre value is there, and again, that's going to be on 85% of base acres. She already talked about the volunteer base. Okay, what about 2026 and the election of PLC or ARC? Based on the Federal Register that was released a couple of Mondays ago, producers are going to know what their production and yields are going to be for 2026 by the time they elect to pick ARC or PLC. So the March 15th deadline is not going to be for the 2026 crop. And also, producers will need to elect for the 2026 crop, otherwise they will not receive a payment for it. And they'll have to revert back to 2025, whatever it was for the 2025 crop year. So be paying attention to announcements from FSA, from your county extension about when the opportunity to elect in ARC or PLC for the base acres for 2026. The delay is happening because FSA has to get farm bridge assistance payments out, and they also have to figure out the volunteer base additions. The data is available there, and they just need to figure out how they want to implement that. All right, I think I want to get into the crop comparison tool in the last 5 minutes or so. Oh, no, wait. The one last thing I did want to say about the payment limits. So payment limits are going to be adjusted for inflation based on the consumer price index. And those numbers are already calculated for the 2025 and 2026 crop years. So the payment limit for 2025 is going to be $160,000. So this October, the payment limit for peanuts and also the other base acre programs is $160,000. For 2026, which would come in October 2027, the payment limit is $164,000. So those payment limits have already been adjusted for inflation. Okay, now I'll go on to the crop comparison tool. All right, so the crop comparison tool is available online. Perfect. I would close it down at the bottom. Thank you. All right, I'm going to zoom this in so we can see it. All right, so this is based on our enterprise budgets, and it allows you to do a side-by-side comparison of what potential returns may be for the different crops based on the budgeted yields and the budgeted cost. Now, ideally, I'm just going to freeze the pane so we can see which crops. All right, when you're looking at planting decisions, you want to see which is going to give you the higher return above variable cost. So ideally, you go in, look at the enterprise budget, change the cost to reflect what your cost of production is, what your historical yields are or expected to be, so it's closer to your actual production practices. Our budgets are aggregated values estimate representative for South Georgia. So there's quite a lot of variation in South Georgia from east to west. So depending on where you're located, definitely take a look at those and adjust the numbers to reflect your costs. Making year-to-year planting decisions, you want to look at your return above variable cost. That's that yellow row that I have there at the bottom. And which one, thinking about crop rotation, all of that in your consideration, which one is going to give you more return above variable cost. Now, I did say, and here it also calculates break-even prices, break-even yields. Now, I did say I used that value on land rent because notice here that's blank on the crop comparison tool. Was it 283? 238. 238. all right, so that certainly changed things and makes the decision harder. And we need to be thinking about how can I produce as efficiently as possible, making some decisions about land rent, or maybe letting go of rented land that is not as productive. But certainly plugging in that value and saying, okay, can we make this work? Or what does my break-even price need to be if we are paying land rent of irrigated cropland of $238 per acre? So break-even price for cotton would be 75 cents a pound at 1,200 pound yield. Cotton, peanuts, $420 a ton. Corn, $5.12 a bushel. Soybeans, just under $10 a bushel. And then looking at dry land, I think I only put it in through cotton, peanuts, corn, and soybeans, so ignore the other ones. But 80 cents a pound for dry land cotton at 750 pound yield, peanuts $4.46 a ton, corn $5.71 a bushel. So I highly recommend in times like this, plug in your numbers, or if you're a crop consultant, working with the growers and plugging in their numbers so they know exactly what their cost of production is. So last Friday we had the Ag Forecast here in Tifton, and last year's Sun Belt Expo Farmer of the Year and also Georgia Farmer of the Year spoke, and he said one of the best things that they have done over the past several years is do a better job calculating their cost of production, because that helps them let go of the things that are less profitable and focus on the things where they can make more money. And I nearly stood up and gave him a round of applause, because I was like, yes, that is exactly the message that we've been trying to communicate for years. So in times like this, we've got to know what cost of production is, figure out the break-even price, and then if we can forward contract or forward price above that cost of production, we're locking in the potential for profit. It may not be the highest price that happens, but it's still locking in that potential for profit. All right, there's 1 minute left to the session. Are there any questions for me or Serena, or any numbers that you would like to see changed in that crop comparison tool? You can find this by Googling UGA crop budgets. It's there on the top left of that page. And your county extension agent also knows how to access it.
I'd like to point out, you're just showing variable cost, not total cost.
I'm not showing the total cost, correct.
Just in case anybody didn't catch that.
Yeah, so making those planting decisions, you want to look at the variable cost. In the long run, you want to look at the total cost, because you've got to be able to replace equipment. You need to provide a return to the land and to management. We also don't have family living withdrawals in there.
One thing you also don't consider, if it seems more profitable on your chart to grow corn, but you have a $1 million cotton picker sitting on your shelf, you don't have a
Absolutely. Yeah. So using that resource, or having a payment for the cotton picker, so you're needing to utilize that asset.
You just can't fluctuate from year to year in some scenarios.
Absolutely. So it's certainly a very tough situation. Or if you don't have the grain equipment.
That's what I meant.
Yeah, you can't afford to buy a combine
versus grain equipment, or vice versa.
Mm-hmm.
Amanda, considering that our fertilizer prices are normally tied pretty correlated to crude oil, how come with the increased corn acres we had last year and the higher gas prices, fuel prices we had last year, what's driving nitrogen prices up so high right now?
A lot of it is demand. So there's some tariffs, but there's high demand and we're looking at potentially planting 95 million acres of corn in the U.S. next year. So that is keeping demand high for nitrogen fertilizer. Corn demands a lot of nitrogen. And the correlation between the propane, all of that, is not as strong as it used to be several years ago. A decade to 2 decades ago.